Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. The 10-year benchmark U.S. Treasury yield rose sharply during the month and closed at 4.68%, approximately 48 bps higher than previous month. The rise in yields was across 2-year to 30-year point of the sovereign curve. These were majorly driven by excessive cautiousness built into the federal officials' speeches compared to market expectations, in addition to sustained inflation numbers and tight labor markets. Fed Chair Jerome Powell indicated a higher for longer for now message of almost all other Fed speakers. The recent data have clearly not given us greater confidence and instead indicate that it is likely to take longer than expected to achieve that confidence to reduce rates. 10-year sovereign yield in Germany also hardened by approximately 29 bps, closed at 2.58% versus 2.29% last month, primarily attributable to stronger macroeconomic data points. Composite PMI in both Eurozone and UK were in expansionary mode and higher than market estimates boosted by services PMI. Further, GDP in Eurozone surprised higher at 0.5% in Q1 current year 2024 versus 0% in the preceding quarter. Core Consumer Price Index on a year-on-year basis also printed at 2.7% for April 2024, higher than expectations of 2.6% in Eurozone. However, labor markets in Eurozone and UK showed signs of slackening weakness. Eurozone unemployment rate at 6.5% for February 2024 versus 6.4% expected, and UK unemployment rate at 4.2% for February 2024 versus 4.0% expected. And retail sales contracted on a month-on-month basis, minus 0.5% for February 2024 in Eurozone and remained flat at 0.0% for March 2024 in UK. 10-year sovereign yield in Japan similarly hardened by approximately 15 bps, closed at 0.87% versus 0.72% in March 2024. It should be noted that the Japanese yen depreciated by 4.2% during the month as well. Domestic 10-year benchmark yield increased by 14 bps during the month, in line with the upward movement of global bond yields in the corresponding period. As can be seen in the chart, the sovereign yield curve bear steepened during the month. The 10-year G-SEC traded in a narrow band of 7.09% to 7.23% and closed at 7.20% in April 2024, as compared to 7.05% in March 2024. At the primary auctions, yields on 91-day T-bill, 182-day T-bill and 364-day T-bill softened by approximately 9 bps, approximately 11 bps and approximately 1 bp respectively. In the first monetary policy meeting for financial year 2024, the Monetary Policy Committee kept the policy rate unchanged at 6.50%. Domestic inflation has moderated significantly from the peak witnessed in 2022 due to elevated levels of interest rates, tighter liquidity conditions, and supply-side measures. However, it continues to be higher than the RBI's target. Going forward, upside risks to domestic inflation remains primarily from the food basket. In addition, recent surge in global commodity prices could also add to inflationary pressures. RBI remains wary about reducing the policy rate too soon, with a clear focus to bring inflation closer to the target of 4.0%. Consumer Price Index inflation for March 2024 printed at 4.85%, lower the previous month's reading of 5.09% and broadly in line with the Bloomberg's median poll of 4.90%. Inflation declined to the lowest level since May 2023, largely led by decline in fuel and light index. Food and beverages inflation remained elevated in March 2024 at 7.68%, although it is marginally lower than February 2024 reading of 7.76%. Within food and beverages, vegetables, pulses, and products and spices have been observing double-digit growth in inflation on a year-on-year basis for some months now. Consumer Price Index ex-food and beverages stood at 2.41%, below 4.0% for the sixth consecutive month, the lowest reading in the current Consumer Price Index series. Core inflation moderated further in March 2024 and stood at 3.25%, compared to 3.37% in February 2024. Liquidity conditions were favorable in the first half of April 2024. However, following the outflows related to GST, systemic liquidity slipped in deficit. Nonetheless, average systemic liquidity remained in surplus in April 2024 at Rs 24,494 crore, better than the average deficit of Rs 38,584 crore in March 2024. In April 2024, daily average of WACR was at 6.59%, lower than 6.71% in March 2024. Adjusted for the government cash balances which are held by the RBI, the durable liquidity remains broadly in surplus. Credit growth stood at 19.9% as on April 5, 2024, on a year-on-year basis, marginally lower than 20.4% in March 2024. On the other hand, bank deposits grew by 13.8% as on April 5, 2024, marginally better than the month-ago level of 13.7%. Global yields moved up during the month as policymakers showed cautiousness regarding future rate cuts. The intent of the Fed to achieve long-term inflation rate of 2.0% on a durable basis remains a valid hypothesis for now. With better than anticipated economic growth and tight labor market, the Federal Reserve gets additional time to carefully analyze the developments in the economy before deciding on the rate cuts trajectory. Three conditions that make the path for the Fed to start cutting rates much easier are, with the backdrop of strong fiscal spending, keeping interest rates higher for longer increases the burden of the interest expense on U.S. government. Real interest rates are significantly positive. Currently, real rate in U.S. is at 2.8%, that is interest rate at 5.5%. Personal consumption expenditure, PCE, for March 2024 at 2.7%. The U.S. Fed's dual mandate of maximum employment with price stability eludes the possibility that an unexpected weakening in the labor market can induce Fed easing, while solid job growth may not deter the Fed from pivoting if inflation is trending lower. However, scenarios of what can go wrong over next few months and the associated risks that remain are: yields at the longer end in U.S. may remain elevated as supply-side pressures persist. That is, likely strong supply of coupon-bearing instruments due to the elevated fiscal deficit. Given Japan's recent policy decision, yields of Japanese government bonds, JGBs, may remain elevated, causing Japanese investors to further withdraw funds invested in U.S. Treasury, UST, as spreads compress. It's pertinent to note that Japan is the largest foreign holder of UST at the end of December 2023. Upside risks to inflation remain given the geopolitical conflicts. Crude oil increased from USD 87.48 BBL to USD 88.26 BBL. Copper prices surged by 12.7% during the month, a signal of potential inflation and robust economic health. While China's economy recovers, inflation may begin to trickle in, thereby exporting inflation to other countries. Globally, rates remain elevated, resulting in slowdown in anticipated inflows on account of inclusion in global bond indices. While domestic inflation is susceptible to volatility due to food components, continuance of resilient domestic growth necessitates no rush for softening in interest rates. The risk of INR to have a depreciating bias basis, the effects of Indonesia's recent rate hike to protect the IDR and PBOK, Public Bank of China, may also allow devaluation of CNY to make its exports competitive compared to the JPY. Refer our fact sheet published in April 2024. The deposit credit gap in the banking system has sustained for a while, indicating that the shorter end of the curve may see higher supply due to the battle to raise deposits in the financial sector, thereby putting a floor for the overall curve. However, reasons capping the domestic yields are Lower than expected supply in H1 FY 2025 borrowing numbers after a lower than expected fiscal deficit. Fairly positive real rates. CPI for FY 25 projected by RBI is 4.5% and repo rate is at 6.5%, maintained for a while, and flows from offshore investors expected due to inclusion in the global bond indices from June 2024 onwards, which can result in a positive demand-supply equation. We have slightly moderated our duration during the month across our portfolios given the increasing risks. However, we remain on the mid to higher end of the respective duration bucket. We stay nimble-footed in tweaking duration on either side if needed given the evolving global macro environment.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.